welcome back to my channel, Capri Spilling the Tea Lifestyle Tips. And I decided to come on here today and talk to you guys about credit score improvement, okay? I know my glasses is giving off a glare, but I need my glasses to read on this screen, but I'm going to take it off for right now. So since it is raining outside, as you guys can see in my background, I said, you know what? I already typed up some stuff about credit that I wanted to let you guys know about. And it's very, what's the word I'm looking for? It's very, what's the word? It's good stuff because it's stuff that you can actually add to your lifestyle. Well, I wouldn't say add to your lifestyle, but you can actually put with what's going on with your credit. So if you have questions about your credit, this basically tells you what's going on with your credit. What's the percentile of a payment history? What's the percentile of new credit? Stuff that I did not know. Okay, so I read up a lot of things on credit because my credit just went up 15 points. Yay. So I was like, wow, how did my credit score go up 15 points? Sometimes I don't even know what I be doing for it to go up. But I'm thinking that it goes up because, one, I don't touch it. Two, I don't do any inquiries. And I'm going to let you guys know what all that is about. My hands are ashy, y'all. I just got out the shower. But yeah, I don't do any inquiries or anything. I don't do any new line of credit. I have done a new line of credit recently, but I'll get into that with y'all also. So the first thing with credit score improvement. So consumers are often shocked to discover how many factors in their credit report, aside from obvious credit report negatives, can impact their scores. So I'm reading off of my little notes here. So basically what it's saying is negative credit can really impact your scores. So let's say if you're trying to go get something like a car, a house, anything that has to do with credit, if you have negative credit on your report, that can impact your score. The reason why it can impact your score is because the person who's trying to give you this car, house, or etc., they're going to look on here like, well, you haven't paid this person. It's negative. We see that you haven't paid this person, so no, we're not going to give it to you. So that is basically what that means. Okay, so take out your notepads and all this good stuff because I'm about to just breeze through. I'm not going to read everything, but I am going to breeze past it. And I'll probably do like a second part to this if there's any questions below. So the first thing that I notated was payment history. Payment history is 35% of your credit. So on a round pie chart, you would do 35% as in payment history. So simply, your credit payment history is one of the most important pieces of information considered in your FICO score. Okay, the presence of a missed payment, collection, bankruptcy, foreclosure, charge-off account, and a derogatory information on your credit report can have a substantial impact on your FICO score. So basically, the FICO score is what the credit people look at. So when I went up to purchase this home, they was looking for that middle number, which was the FICO score. That middle number had to be a 620 or up. That is your FICO score. So you have to make sure you do have good payment history. Because if you don't make sure you got good payment history, if that FICO score is under 620, at least I know in the state of South Carolina, you're not getting anything. Okay. Let me see. They did say the FICO score considers late or missed payments, collections, and public records, bankruptcy, tax lines, etc. Recently, they occurred how many they were, how much was owed, and how many there are. The more recent, severe, and frequent the late or missed payments, the greater the impact on the score. So therefore, if you just was late on a payment, and you try to go out and get something, they see that, they was like, oh no, basically you still messing up. So yeah, we ain't going in with you. You still messing up. So nah. However, as a negative information on your credit report ages and your more recent credit activity is positive, the older negative information has less of an impact on your FICO score. So basically, let's say I try to go up to get a car. And it's 2018 now, but I had something back in 2001. They're going to be lenient. They're going to basically kind of forgive and be like, okay, that was years ago, almost 18 years ago. Let's see what I can help you with. Let's see if you got your thoughts in your head together to get back to do what you're supposed to do. So that's what that is. When considering whether or not to lend you money, the primary goal of a potential lender is to determine what the odds are that will not repay a debt. Your credit payment history is one of the primary categories of information that have access whether or not you repay your debt in the future. Just like I said, they look at stuff on your credit to verify if you haven't paid them, what makes you think you're going to pay me? Nah. That's only if it was like yesterday you was late. But if it was like in 2001, they may forgive it. They may take it off your credit. But if it's something like 2017, 2016, because with most people, they go back 2 to maybe 3 years. Sometimes 4. It all depends on who you're dealing with and what you're trying to get. Let me see. Okay, so that's on payment history. Once again, that's 35% of your That's 35% of your on your credit pie chart. Okay, then we have new credit. New credit is 10%. So, with new credit accounts for 10% of your credit score. This category is impacted by the number of times you apply for credit and open new accounts. Whenever you apply for a new credit, whether it's a mortgage lender, car dealer, or retail store, they are very likely to pull your credit report as part of the credit application process. When they do this, it causes a credit inquiry to appear at least one of your credit bureau reports. The more credit inquiries you have, the more impact it will likely have on your FICO score. So, let me tell you this. Young people are most likely to do this. Young people are mostly likely to go out there and try to get new credit. They'll go get a car around tax time. It'll get repossessed around April. And then next thing you know, they're back out there again, trying, around the holidays or whatever, trying to get another car. But once again, they're looking at, okay, you couldn't even pay on this car. That goes back to the payment history. That's 35% of your pie chart. They're looking like, okay, you couldn't even pay for this car. You only had this car for like 3-4 months. So we pull that and we see that, no, I'm sorry, we're not giving you a vehicle. So that payment history and that new credit goes hand in hand. So basically it's like these new people done pulled your credit for nothing. And now 10% of that, them pulling your credit is an inquiry. You don't want a lot of people pulling your credit because that's not a good look either. A lot of people pulling your credit, that's not good. That means that you're shopping around and you just got your credit all over the place. You don't want to do that. So why do inquiries matter? So inquiries matter because most scoring models consider consumers that open or apply for new credit accounts in a short period of time as a higher risk. Once again, you all over town, people pulling your credit. Okay? Your FICO score will likely be impacted when you apply for new credit. The degree of impact will vary based on your unique credit profile. Generally speaking, however, new inquiries have a relative small impact on a FICO score. While many retailers will try to entice you to save 10% on your purchase by applying for their retail credit card, keep in mind that this could negatively affect your FICO score. It's generally wise to only apply for credit that you need and intend to use prudently. Now, that's another thing. It's not just for a car. You do have some females out here that loves to shop, love their percent discount off. So you'll go to Dillard's, apply for their card, boom, that's a new inquiry. You'll go to Sears, apply for their card, boom, that's a new inquiry. So you got all these inquiries within a couple of days apiece. That's not good. Because once again, they're looking at your chart like, okay, you just went to Dillard's, Sayers, JCPenney, Burlington, and you done applied for all these cards. Like, that's not good. Hopefully you could pay it back or your payment history gonna be messed up. So that's why inquiries do matter. So only apply for things that you really need, like a car or a house. Don't apply for credit cards that you really don't need. To be honest with you, I was never the type to apply for different cards like Dillard's, JCPenney, Burlington. I always was like, if I apply for a card, it'll be one card, which is like Capital One, but and use that at the shopping centers, but I won't apply like for their card because sometimes their card has more interest rate. I won't apply for Walmart. I won't apply for Lowe's and Home Depot. I will apply for one card, which is Capital One, or I would get a loan from my bank, and that's it. Like, I was never the type to apply for all these cards. All right. Then they have hard inquiries versus soft inquiries. So all inquiries are not the same. Okay? So there are some confusion regarding which inquiries are considered by FICO scores. Every time a credit grantor, car dealership, bank credit cards, look at your credit file. When you have applied for credit, a hard inquiry appears on at least one of your credit bureau reports. These hard inquiries remain on your report for 2 years. However, only inquiries in the past year are considered by FICO scores. Okay? When you or another credit person access your own personal credit reports from TransUnion or Equifax or Experian, this is considered as a soft inquiry and will not impact your FICO score. Other examples of soft inquiries will be pre-approved offers, account review inquiries, and coming from employee inquiries, so like your employer. While these inquiries remain on your report and look anonymous, they should not impact your FICO score. So those are the difference between a hard inquiry and a soft inquiry. So employers, they look at your credit, that's a soft inquiry. That's not bad. Just like when you pull your credit or another credit bureau pull it, that's a soft inquiry. But if you're going to a car dealership, a bank, a credit card, they pulling. They looking at everything because they want to see who you went to, who you didn't pay, who you did pay, what's your credit score. They're looking at all that. So it's a hard inquiry. So that is the difference between a hard inquiry and a soft inquiry. Okay. Then you also have the smart rate shopping. And I'm going to just kind of like breeze past that. So just like I said before, you don't want to go shopping around for messing up your credit, just shopping around for like cars and stuff like that. Okay. So FICO scores also account for rate shopping. Okay. Looking for mortgage, auto or student loan may cause multiple lenders to request your credit report. And I'm going to stop right there. And I am going to say, when we were looking for a home, basically, it wasn't the home. It was more like looking for a mortgage person. Because I had two mortgage people. I had one that was, let me see. I had one guy, he pulled my credit. And he was like, well, looking at your FICO score, it needs to go up 2 points, And then by the time I had this other guy pull it, it was where it needed to be. So then it's like, you don't want to go back and have this person pull it just because this person says where it need to be. You got to just stick with the person where it says, okay, you at where you need to be. And don't let anybody else pull your credit. Because now when I look on my credit report, I see that, I see this guy who pulled it and I see this guy who pulled it. You see what I'm saying? So now I'm just sitting here like, oh, I should have never went with this guy. I should have waited, and went with this guy. Okay? So that's what smart rate shopping is. Even though you are only looking for one loan, you're still shopping around. And they're pulling your credit. Okay? So to compensate for this, the score ignores mortgage, auto loan, and student loan inquiries made in the 30-day prior scoring. Now they do ignore it, but it still shows up. But if you're trying to get something and they see that you were like mortgage shopping or I guess auto shopping, they say that they ignore it. Okay? So if you find a loan within 30 days, the inquiries won't affect your score while you're rate shopping. So the credit bureau ignores it, but the people who's pulling your credit, they can also see that you've been shopping around. Okay? Because matter of fact, the guy, my mortgage guy, Tom, I had to sign something that said that I know it was something about the other guy pulling my credit. I had to sign a disclosure about that because he saw that someone else pulled my credit. So just like I said, when you're mortgage shopping, car shopping, everybody may not get you to sign it, to sign that little disclosure that I did, but my mortgage guy was like, sign this. For what? I don't know. But they're saying that the credit bureau excuses it if you're rate shopping within 30 days, they don't touch your score, like it's not in bad standing. Let me see, credit score. Okay. In addition, the score looks on your credit report for mortgage, auto loan, student loan inquiries older than 30 days. If it finds some, it counts those inquiries that fall in typical shopping periods as just the inquiry that determining the score for the FICO score. So I'm not going to go too much in depth with that. Basically, I already told you guys what smart rate shopping is. So just remember, if you're looking for a home, a car, if you're going to shop around, please do it within those 30 days. Do it within that month. Don't do it in February and then stop and then go and do it in March. You know, just do it all in that 30 days for it wouldn't impact your score that bad. Okay? So that's smart rate shopping. And if I'm not giving you a percentage, that's because it's not a percentage on the pie chart. It's just basically giving you information. And another thing, if you guys want this information to read over for yourself, just link your email down below and I will try my hardest to get it to each and every one of you because all I have to do is like copy and paste it and you guys can go from there. But this is information that I actually got from my credit people, okay, who I went through. Which is Lexington Law. And I tell people that all the time. I broadcast them like I work for them. So this is information that I actually got from them. So if you guys want to read over it, drop your email down below and I'll try to link it to each and every one of you. All right. So the next one is amount owed, which is 30% of the pie chart. So amounts owed category of your credit score analyzes your use of your available credit. The category considers both your installment loans, mortgage or car loan, and revolving accounts. Credit cards, lines of credit, generally speaking, your revolving credit usage is more heavily weighed positively, negatively in the score. Okay, so that's amounts owed. Basically, it's self-explanatory. If you owe anything, it's 30% of the pie chart. So don't try to owe nobody, okay? I think the longest one is revolving utilization ratio importance. That's like the longest, okay? Let me see if I can give you guys like an example. Okay, so let me just read the top and then go from there. So the references the balance you owe on revolving accounts. If you have $1,000 limit credit card and you owe $500, your revolving utilization ratio is 50%. Add up the balance on all of your revolving accounts and divide by the sum of the limits on your revolving accounts, and that's your overall revolving utilization ratio. Lower revolving utilization ratios are considered favorable by the FICO score. Remember that FICO scores consider how you use your revolving credit in several ways. Your overall revolving utilization ratio discussed above, and 2, your utilization ratio in specific types of number of accounts discussed below. And I'm not going to go into all that, but let me tell y'all about that. So revolving utilization ratio, important, like me. Okay, I borrowed $3,000 from the bank. You borrowed $3,000 from the bank. you don't want to use all $3,000. Now, I don't think it's so bad when you borrow the money from the bank, because what they do is they put the cash in your account. But if you do a credit card, and just like he said, well, just like he or they say on here, you have $1,000 limit and you spend 50% of that. They really don't want you to spend 50%. They really want you to spend 30%. It's crazy because you're looking at it like, okay, I borrowed $1,000 because 5 out of 10, I need either all 1,000 or all 800, but they want you to use only 30% of that $1,000 limit that you borrow from them. They want to see that you use the money, but you don't use all their money and you're not depending on the money. It sounds weird, but that's the way the credit bureau looks at it. Okay. And once again, that does not have like a percentage by it, because that's just information that I'm giving you guys. Then it moves down to credit limit increase instructions. So when consumers carry a high debt to credit limit ratio, which is what we're talking about, higher ratios such as 50% or greater are considered riskier for FICO score as compared to lower ratios. So once again, and when you're using more, that they're looking at it like 5 out of 10, this person ain't gonna pay this back because they're using more and they're using it every single time. Okay, so if you have, for example, if you have a $900 balance on the credit card with 1,000 credit limit, that particular card would have a 90% revolving utilization ratio. However, if your credit card provider were to increase your credit card limit to $2,000, you will only be at a 45%. This may positively impact the score. So, just like they said, if it's at $2,000 and you use $900, that's fine. If it's at $1,000 and you use that, that's like basically the whole card. They don't like when you use all of the money. Even though you ask for $1,000, they don't want you to use $1,000. So if you know that you're going to need about $800 to $900, then you need to ask for $2,000. You may not be eligible for it, but I'm just saying that's going to make your credit look good. Okay. Let me take another look. All right. Then we have credit length, which is 15% of your pie chart. Credit length category analyzes how long your credit accounts have been established. One way this is measured is by the age of your oldest credit, or your oldest account, I'm sorry. Another measurement is the average age of your account. Typically, the longer your credit history, the more points awarded in a FICO score. A long credit history allows creditors to view a longer sample of your past transactions, and based on the results of your payments, they are able to make a more analytical prediction of your future credit behavior and gauge risk. However, if you only have a few open accounts just recently opened, maybe you've a recent student or just younger and just getting into the credit game and you don't have a lot of long open accounts, there are other ways you can build a positive credit history. So with that being said, back in the day when we used to ask our grandmama to sign for a car or something like that, because they've been in the game longer than us and they have credit history. If you just getting out of high school, you don't have any credit history. Hopefully you don't. Hopefully your mama wasn't using your name. But if she was using your name, then you win the game because she's been using it for a long time. And hopefully she's been doing good with your credit. And I always tell my kids, if I ever use your credit, just know y'all going to be in the game. Y'all going to be good because I'm starting y'all off with credit history, but it's going to be in good standing. So when you guys go out there, y'all be in good standing. But then you got some mamas, they can't pay their bill. So they put it in a child name and then they don't pay the child bill. So now that you jump in the game, you don't even have a chance because your mother, your aunt, your daddy, whoever done mess you up. Okay, so that's the credit length, and that's 15% of the pie chart. Okay, and then they also have the credit mix for 10%. credit mix. Okay, I never heard of this before until they sent me this. I'm like, what is a credit mix? They making up stuff now. They always making up some stuff. But credit mix category is relatively minor. It's one piece of the credit scoring puzzle that shouldn't be overlooked. Okay, the presence of certain types of installment loans, such as signature loans from finance companies, may actually negatively impact your FICO score, even if you pay them on time. Okay, so credit mix, which is 10%. The credit mix is payment history, that's 35%. Amounts owed, that's 30%. Length of credit history, 15%. Types of credit in use, that's credit mix, that's 10%. Then you got new credit, which is 10%. So you have 5 categories that should make up about 100%. Let me see, 5, 10, and then 6, 7, 8, 9. Yeah, so it should make up 100%. The biggest thing is payment history, then amounts owed, then length of credit, and then the last 2 is credit mix and new credit. So, that was the end of it. Oh, I'm good. I'm still under 30 minutes.